let me quickly welcome in all our guests who are joining us on the show to take this discussion forward. We have Feroze Azeez, Deputy CEO of Anand Rathi Wealth. Welcome to the show, gentlemen, and thank you for making this time as well. Overall, if you see, before we go to Mr. Das Gupta, let me actually first take a question with Feroze Azeez. Feroze, welcome to the show. My first question coming to you is, taking the bilateral conversations into consideration between India and China, what is your initial assessment when you talk about the market's reaction on the outcomes of this bilateral meeting? How do you see markets digesting this now?
Good afternoon, Feroze. To my mind, markets will react positively. What has happened in the markets is, if you break participants of the markets into 3-4 categories, the domestic institution, the foreign institution, into a couple of other markets like cash market and the derivative market, the FIIs are already significantly sold in the cash market. They are almost 90% short positions in the index futures market, which means that already there's a lot of selling which has happened. Over the last couple of years, almost 4 trillion rupees of sale has been done by FIIs. So point I'm trying to get to is, any such positive sentiment booster also creates a huge short covering possibility. At least there is a seed sown for some short covering, which has actually dampened the market. And we've seen almost an 11-month time correction, 6-7% price correction, and also an earnings of 11% in Nifty from September last year has got discounted without any rise in the market. So point one, I think this will create a positive sentiment, especially because it's coming from a time frame where you've seen a lot of global uncertainty, especially due to the trade war since April. The broader market is reasonably negative. Almost about 2/3 of the stocks in the small cap index are down 25% from their 52-week highs. So if there's a stored potential energy in the market, I think this can unlock it, or at least sow the seeds for that to happen.
Right. So, we're talking about the trade deficit as well from here on. Feroze, let me come to you. We spoke about the way markets could take it as well. Now, given the discussions with regards to where easing restrictions go on the Chinese FDI aspect as well, what is your view on the potential for increased Chinese investment in India? And how do you think this could actually benefit key industries?
Yes, I think relaxing the FDI norms in the non-sensitive sectors, such as renewable energy, manufacturing, which is textile, electrical goods, farm equipment, is going to be a very, very useful thing, especially auto component and stuff. So today the restriction is close to about 20-25% of FDI limits. If those are relaxed, then it creates a lot of not just the capital, but the technology, because of the collaboration, which is very critical with China. China is far ahead of us on technology in precision equipment, for example. In several aspects of manufacturing, they are ahead of us. There's no harm in acknowledging that. Any kind of investing relaxation results in not just capital, but intellectual capital as well, because of the collaboration which will come along. So I'm very positive that these 4-5 sectors which I rattled out will have a strong benefit. I think there are other sectors also, because of this tension going away and we improving our ties with China. I think one sector which will get a huge benefit will be the capital market sector. I think that's one sector which has been under tremendous pressure for the last year and a half, from global uncertainties to trade wars to anything positive from a trade or global perspective has not come its way, be it FII flows or FDI flows for that matter. I think the capital market sector has a Nifty Capital Market Index, which was formed not too long back, has about 15 stocks. 14 of them are negative for this financial year, and substantively negative. I think that's where some value will emerge. Once there is some positive news, not just domestically. I think capital markets have just got a tailwind from the domestic flows, but I think globally we've not got any positive news. I think that'll be one sector which your colleague didn't speak of, so I thought it was wise to add on.
But running out of time, my last question coming into Feroze. Feroze, in view of everything, Soumit also took us through a couple of sectors that could benefit. You're talking about pharma, marine products, renewable, EVs could gain as well, tourism, manufacturing, minerals. Now, if you have to look at all these aspects, how do you think should investors, both domestic and foreign, actually adjust their portfolio to account for this evolving dynamics of India-China relationship? Because that is what, in the end, the investors want to know.
Yes, absolutely. Investors make money on where they lay their chips. So I would say, see, where Indians, different sectors are poised, I think the consumption push, which is getting domestically given a lot of impetus, is still going to steal the limelight. Of course, so many of the sectors which we see and speak of when we're speaking about China have been under stress. Like if you look at auto, there's so many sectors, be it the renewable energy, infrastructure has gone out of flavor, consumption has come into flavor. There's been a lot of capital movement. If you look at almost the top 10 infrastructure stocks have moved its capital, other people have moved monies from there to consumption, and they've not been at their 52-week highs, all the infrastructure, capital goods, industrial stocks. I think this will bring in some stability to them. But looking back at where the investor should have his money, I think the largest sectors which contribute to Nifty and NSE 500, for example, financial services, is 31% in Nifty. That's a lot of weight, right? Pharmaceutical is just about 3.5% weight. What I'm trying to get to is still be domestic facing is what I would say as an investor, because value is there and push is there. The other sectors where you have stocks, and those were correcting rapidly over the last month and a half or two, they will get some degree of base formation, and that's what this deal will do for you. I think there's an equilibrium between mid cap, large cap, and small cap, which was not there in the first quarter of this calendar year. Now there is almost an equilibrium. So having 50-60% of your money in large and breaking the rest of the portion into mid and small cap, and being more domestic sectors, heavy weight in those sectors will help you. And if you're stuck with some stocks, be rest assured you don't have to exit them yet, because there is some degree of positive news coming for those. And so the pain will reduce rather than a lot of shift of capital with this news.
Absolutely. Would be my pain will reduce, and we're not talking only about the financial pain. There is a lot of strategic pain that does go out of the system as well, from a geopolitical perspective as well. But thank you, Feroze, for joining us on the show and sharing all your views, because when you're talking about bilateral trade, the Modi-Xi Jinping dialogue becomes absolutely crucial. But completely out of time. With that, it's a wrap on this edition. Lots more lined up on the other side. Please stay tuned to NDTV Profit.